let me ask you something that might make you uncomfortable. Right now, at this very moment, how much money do you have working for you while you sleep? Not the money sitting in your checking account waiting to pay bills. Not the emergency fund tucked away in some low-interest savings account. I'm talking about real capital, invested money that's actually generating wealth whether you're at work, on vacation, or sound asleep in your bed. For most people watching this video, the honest answer is either nothing or not nearly enough. And that's exactly why we need to talk about the most important number in your entire financial life: $100,000. Not a million, not 10 million, just 100,000. Charlie Munger, Warren Buffett's partner for over 40 years and one of the sharpest financial minds who ever lived, said something that should be carved into every young investor's brain. He said the first $100,000 is a complete nightmare to accumulate, but you absolutely must do it because everything changes after that. Everything. Now, why would a billionaire who's seen every market cycle, every economic crisis, every boom and bust, say that this relatively modest number is so critical? Because Charlie understood something most people never grasp until it's too late. He understood that wealth building isn't linear. It's exponential. And there's a specific inflection point where the mathematics shift dramatically in your favor. That point is $100,000. Think about this for a moment. If you're starting from zero and you manage to save and invest $1,000 a month, which is already more than most people can do, it would take you over 8 years to reach $100,000. If your investments just sat there doing nothing, but here's where it gets interesting. Once you have $100,000 invested in a diversified portfolio of quality businesses or index funds, and that portfolio grows at a conservative 10% annually, which is roughly the historical average of the stock market, you're making $10,000 a year without lifting a finger. $10,000. That's the same amount that might have taken you 10 months of disciplined saving when you were starting out. Your money is now doing almost a year's worth of saving work in just 12 months. This is when you stop being someone who's just putting money away and you become someone whose capital is actually working. You're no longer just an employee trading time for money. You're an investor with serious skin in the game. And the compound interest machine has finally reached critical mass where you can feel it, see it, and believe in it. But here's what nobody tells you about this journey. And this is where most people fail. The path to that first 100,000 is absolutely brutal. It's not complicated, but it's hard in a way that tests every ounce of discipline you have. While your friends are upgrading to luxury apartments, you're staying in that modest place. While everyone's posting vacation photos from Bali and Barcelona, you're taking weekend trips to nearby towns, while your colleagues are leasing new cars with payments that could fund a retirement account. You're driving that paid-off vehicle for another 3 years. This is the sacrifice period, and it separates people who build real wealth from people who just talk about it. Warren Buffett himself, now worth over $100 billion, lived in a modest house in Omaha, drove old cars, and famously said he never felt poor because he was always rich in the possibilities that his accumulated capital would create. He understood delayed gratification at a level most people can't comprehend. Every dollar he didn't spend on impressing others was a dollar that could compound for decades. Every sacrifice was an investment in future freedom. And here's the truth that might sting a little: if you're not willing to live differently than everyone around you for 5 to 8 years, you're going to end up living like everyone around you for the rest of your life. Which means working until you're 70, stressed about money, dependent on a paycheck, and hoping nothing goes wrong. Now, let's talk about what happens inside your head when you hit that $100,000 mark, because the psychological shift is just as important as the mathematical reality. When you're starting out with $5,000 or $10,000 invested, it still feels like you're playing a game that doesn't really matter. The numbers are too small to create any emotional significance. You check your account and you're up $300 this month. That's nice, but it doesn't change anything about your life. You're down $500 the next month because the market had a rough week. It stings a little, but again, it doesn't fundamentally alter your reality. But something profound happens when you cross into six figures. Suddenly you check your account after a good month and you're up for $1,000. That's more than some people make in an entire month of work. Then the market pulls back and you're down $6,000 in a week. And now you're feeling actual pain because that represents real money, real purchasing power, real opportunity cost. This is when you stop being casual about investing and you start thinking like a serious capital allocator. You become more thoughtful about risk. You become more interested in understanding what you actually own. You start reading annual reports, listening to earnings calls, understanding business models, studying economic cycles. You're no longer just throwing money into random stocks because someone on social media said they were hot. You've got too much at stake now. This psychological evolution is exactly what needs to happen for you to build serious wealth over decades. Here's where the magic really starts to reveal itself. And this is the snowball effect that Warren Buffett talks about in almost every interview he's ever done. Getting from 0 to 100,000 might take you 7 or 8 years of consistent investing. But getting from 100,000 to 200,000 with the same monthly contribution rate, that might only take 4 years because now you've got compound interest working with serious capital behind it. Then from 200,000 to 300,000 takes maybe 3 years. From 300 to 400 takes even less time. By the time you reach $500,000, the compound growth becomes almost magical. You're making $40,000 or $50,000 a year just from investment returns, which might be close to what many people earn from their actual jobs. This is when financial independence stops being a fantasy and becomes a visible reality on the horizon. But none of this happens without crossing that first critical threshold. None of it. That's why Charlie Munger was so emphatic about the difficulty and importance of the first 100,000. It's the foundation that everything else is built upon. Now let me tell you about one of Warren Buffett's most important rules. Something he's said so many times that people almost tune it out, but you need to really hear this. Rule number 1, never lose money. Rule number 2, never forget rule number 1. People laugh when they hear this because it sounds overly simplistic, but there's profound wisdom embedded in those words. When you're building toward that first 100,000, every significant loss sets you back months or even years. If you gamble on some speculative stock because you want to get rich quick, and you lose 30% of your portfolio, you've just destroyed months of disciplined saving and investing. You've got to make back that 30% loss, which requires a 43% gain just to get back to break-even. And then you've got to continue making progress from there. This is why Warren Buffett has always advocated for simple, low-cost, diversified index fund investing for ordinary people. It's not sexy. It won't make you feel like a genius stock picker. But it works. It's worked for over a century. The S&P 500 has returned roughly 10% annually over the long term. And if you simply contribute consistently to a low-cost index fund and never panic, sell during downturns, you will reach that $100,000. It's not a matter of if, it's a matter of when. And the timeline depends entirely on how much you can invest each month and how disciplined you remain. Let's get brutally honest about the timeline because I want you to have realistic expectations. If you can invest $500 per month into a diversified portfolio, earning 10% annually, you'll reach $100,000 in approximately 10 years. If you can push that to $1,000 per month, you're looking at about 7 years. Time is going to pass regardless. The only variable you control is what you do with that time. Warren Buffett didn't get wealthy by making brilliant trades every week. He got wealthy by making reasonable decisions consistently over 50 years and letting compound interest do the heavy lifting. At $1,500 monthly, you'll get there in roughly 5.5 years. And if you can somehow manage $2,000 per month, you're looking at just under 5 years. Now I know what some of you are thinking. 10 years sounds like forever. 7 years feels impossibly long.